Wages crept higher in the monthly jobs report, and many businesses are reflecting on higher input costs. There's no doubt that the base effects of comparing this year of reopening to last year's economic shutdown, along with the obvious supply bottlenecks, are setting us up for some higher than average inflation data over the short term. Although we're not predicting that inflation will run hot for a sustained period, it's natural for investors to look at their portfolios and ask, what if, and wonder where are the inflation bumpers. This is particularly important as we think about funding lifestyle goals. Now, these tend to be the goals that are the most sensitive to inflation. So, where are the inflation hedges? Let's break it down. First, your portfolio likely has exposure to global equities, and actually looking at history, they provide pretty good correlation to inflation, to a point. A little inflation is a good thing, up to around 3.3%, and that's a far cry from where we are, and even further from where we see inflation longer term. Above that level, though, it does look like higher inflation is a headwind to equities, but that's colored by past experience when the Fed was quick to tighten as inflation ticked higher. We're in a very different world here, where the Fed has stated explicitly that not only will it not predict inflation, but it's also going to be slow to react to higher inflation. This probably means that equities can withstand higher inflation over the short term. So what about bonds? Well, the purest way to get an inflation hedge is through TIPS, or Treasury Inflation Protected Securities. Now, we hold TIPS always in a strategic portfolio, and TIPS are core in goal-aligned portfolios with a focus on lifestyle spending. Next, we recommend an equity-based natural resource exposure, and we look at this as the best of both worlds. You've got the equity exposure from the underlying companies, and you also have a historically strong and positive relationship to short-term upside inflation surprises. And last, what about gold? Now, many think gold is an effective inflation hedge, but looking at the actual data shows us that the correlation is not as strong as the anecdote. Although there is a correlation, it comes with a lot of volatility, and we would consider that to be uncompensated risk. At the end of the day, it's likely that you already have assets in your portfolio that will protect you in a period of higher inflation, and it's possible that we could be in a short-term period of higher prices. In fact, that's already an expectation baked into today's market prices, with 5-year inflation break-even sitting at the highest rate in 15 years. That said, we believe the longer-term outlook for inflation remains benign, with the structural headwinds ultimately overwhelming any cyclical uptick.